Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of the Chicago soybean complex. Chicago soybeans. I've spoken now for many weeks about the longer term charts and explicitly the 5-year moving average, currently 1192. This ultra long term moving average plus the 2021 low at 1181 provided the reason for the mid-May to mid-June hesitation and eventual aversion from going lower. I said 6 weeks ago it was worth keeping a close eye on these, and so it has turned out. These all brought beans back again into the teens. The two key pieces of action for the move up were provided 5 weeks ago by a pair of opening long white Mariposos. The second of these punched up through some key resistances. They were the combination of the base of the late 2022 descending triangle and the lesser Fibonacci line, both at 1378. These turned from being resistances into supports. That doesn't mean that they were not tested, as we saw 3 weeks ago. But the next moving average below, the flatlining short-medium moving average, currently at 1362, held up the market and prices punched back up again, with what turned out to be a weekly key reversal up. The move up also punched through and closed over two key resistances: the declining medium moving average, currently at 1409, and a flatlining long moving average, currently at 1439. The latter had been effective as a cap throughout June and caused a pipe top just after the middle of the month. The separation of these two moving averages after they had formed a dead cross only a few weeks prior, at the start of June, no doubt assisted in breaking up through their individual powers could not match the sum of their powers combined. There was then some hesitation at the next overhead significant resistance, the 50% Fibonacci line of the big December 2020 to February 2022 move at 1451, which had beyond it another big 50% Fibonacci line of the February 2022 to May 2023 move at 1476. However, the market did punch up through the former, but had a real problem in stabilizing over the latter, such that when changeover came, we ended up with a gap between 1470 down to 1417. The lower end being back where the moving average now sat. There has since been a recovery, filling in a large portion of the changeover gap, though it's still an open gap at this time. The reason why we've not filled in the gap is fairly obvious. It is the combination of the long moving average on a closing basis and the 50% Fibonacci line at 1451. This leads us to what the recent late June to date action could be, or should I say could be seen as, because it hasn't fulfilled this possible idea as yet. You see, if you look back late March and into April here, you will see that we made a double top, with the highs being based on the 1500 area. Well, the recent action bears a strong similarity to that action. So the question is this: do we have a similar double top now? Well, the move down to the base of the 1400 zone this week looks similar, but it will depend on whether the prices can stop trying to fill that gap that's still open overhead. One vital difference now compared to then, to that time back in May, is that we are in a different point in the changeover cycle. We are further behind. We ought not to rely on a big changeover gap as we did back then. Chicago soybean meal. The biggest pattern here had been the May 22 to date, broken, then repaired, then broken again, and seemingly now desperately trying to be repaired again, ascending, expanding wedge pattern. It's a huge pattern that I pointed out many months ago. It was never a perfect pattern by any means, but it finally started working in late May this year. To assist you in seeing this pattern, I've highlighted it on my daily chart in dark blue. However, the upper trend line is slowly exiting top left, though the lower trend line, currently at 428 even, is still here, and is also the neckline of the huge December 2021 to June 2022 head and shoulders continuation pattern. The break lower this past May, below this trend line and neckline combination, indicated a potential primary target that is still well off the bottom of my daily chart, at the incredible 324 zone, and a secondary, harder to reach, much harder to reach target in the 283 zone. These are ones that you can make a note of in your diary and maybe look at once or twice a year. However, the resurgence back up in mid-June from the double bottom, Adam and Eve type that is, this has postponed any potential big picture targets below for the moment, and instead concentrated vision on the top side. Thus, from the double bottom, the market had punched up and closed over the following: the 50% Fibonacci line of the October 2021 to March 23 move at 403.60, the now flatlining short medium moving average, currently 408.80, the declining medium moving average, currently 430.5, the lesser Fibonacci line at 425.90, the neckline of course, the combined congestion made up from the early April 2021 high and highs from January and February 2021, all at 433.5, and finally the flatlining long moving average, currently at 436.10. The market has stopped short of testing the next resistances of the April 2021 high at 439.30, much as it did in early and mid-May. Indeed, it has started to show with yesterday's actions and marked indecisiveness that it is already hinting at a possible sympathy for a topping action. However, please bear in mind one thing. Though I haven't drawn it as yet, the action since mid or even late June has a strong possibility of being an ascending triangle, such that I would watch carefully any moves lower just in case. This brings me once again to my final point, which I raised 7 weeks ago and ever since. You see, on my long-term monthly charts, with still less than half a year gone, well, it's now over half a year gone. With over half a year gone, 2023 is set up to possibly be an annual key reversal. Thus, if we were to close on New Year's Eve 2023, either above 471 even, or under 399.10, then we'd be on. Anything in between will have a lesser outside year. Right now we are looking at a possible outside year, but we still have so many months still to go. Chicago soybean oil. The key pattern here, which I highlighted a good while ago, is the late November 2022 to early June 2023 descending wedge pattern. This is easily seen as it is highlighted in purple on my daily chart. It was not a perfect pattern. Well, you could hardly expect it to be after over 6 months of continually watching the market and trying to thread it in between the two trend lines. However, 6 weeks ago, the market broke higher out of this pattern. So for such a confirmed break higher, there is a primary target X in the 67.5 area, where secondary, harder to reach target X1 for such a pattern in the 78.20 area. Last week prices came awfully close to reaching the primary target, but started lower this week, though they have since regained the lost ground. The reason for the move lower was last Friday's counter-to-counter bearish dark cloud cover pattern that indicated inter-day indecision, and this indecision in turn was prompted by two important 50% Fibonacci lines. The first one was the stalwart January 2021 to April 2022 move at 64.09, and the second was the more recent April 2022 to May 2023 move at 66.18. The market was above the former for a significant period, mainly the whole of last week, and it was obvious it was not happy being up there. And you only need to look back at the action around the ascending wedge pattern back in December last year, plus the highs at January this year and late February, to see the impact of the 50% Fibonacci line. The second 50% Fibonacci line at 66.18, well, that put a lid on the market. And it could be argued that if this second 50% Fibonacci line wasn't there, then the move up above the first 50% Fibonacci line at 64.09 could have reached target X last week. Instead, we had a drop off, though prices only dropped off as far as the short moving average this week, currently at 62.57, before moving back up again, and testing and seemingly pushing through the 50% Fibonacci line at 64.09 once again, and target X is back in the frame. Now, one final thing, and something I mentioned 3 weeks ago. It was this, and I quote, "I would still consider the break higher to still be a live one, but, and it is a big but I would consider this descending wedge pattern may, just may, have lately morphed into a possible scallop pattern." End of quote. I'm not going to expand on this area any further at this time, with target X still, as I say, in the frame. But I wish you, and also me, to just keep this in mind. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.